As economic prospects darken, the European Central Bank delivers its first interest rate hike since 2011. With inflation already approaching double-digit territory, it is now at risk of getting entrenched above the European Central Bank's 2% target, requiring rate hikes even if that slows an economy suffering from the impact of Russia's war in Ukraine. Policymakers were far from united on just how fast the European Central Bank should have made the move, with some arguing that it is already a long way behind the curve, especially compared to global peers like the US Federal Reserve, while others point to a looming recession that the European Central Bank risks exacerbating. Raising rates in a downturn could magnify the pain as businesses and households face higher financing costs. Confidence has already taken a big hit. This war is affecting the economy in Europe and beyond. The invasion and the associated uncertainty have prompted some repricing in global financial markets. Higher energy and commodity prices are pushing up inflation and slowing the economic recovery. Elevated volatility has highlighted some liquidity risks, notably in some commodity derivatives markets. However, the main threat to euro area financial stability comes from the impact through macroeconomic channels. This implies additional challenges for indebted businesses at a point in time when countries' fiscal space is very limited and support may need to be more targeted than the broad fiscal policy response to the pandemic. High raw materials prices are depleting purchasing power, pushing the bloc towards a possible recession, especially with looming gas shortages. One problem is that a gas shutdown would not only hit growth, but would also boost inflation, and therefore the European Central Bank may not immediately become more growth sensitive. The European Central Bank's ultimate mandate is controlling inflation, and rapid price growth for too long could perpetuate the problem as firms automatically adjust prices. Europe's labor market is also increasingly tight, suggesting that pressure from wages is also likely to keep price growth high. Some central banks, most particularly the Fed, have made clear they are willing to crash growth to control inflation because the risk of a new inflation regime setting in is too high. But if a recession is coming, the European Central Bank needs to front-load rate hikes so it gets done quicker. Higher interest rates challenge the valuation of riskier assets, such as equities. Euro area sovereign and high-yield credit spreads have widened over the course of 2022. Spread increases are in part related to the rise in underlying risk-free rates, as the latter mechanically have a larger impact on the earnings and budget deficits of more indebted firms and sovereigns. Large shifts in commodity prices and related margin requirements have posed challenges to liquidity management for some derivative market participants. Commodity derivatives markets are used by a wide range of firms, including energy producers, suppliers and distributors, and users, to manage risks arising from volatile commodity prices and enable them to fulfill contracts with corporates and households. Investment funds saw manageable outflows following the invasion, but euro area non-banks remain vulnerable to a further market correction, given high duration, credit, and liquidity risk. Limited aggregate exposure to Russian and Ukrainian assets meant that only a few of the more specialist investment funds were suspended. That said, since early 2022, there has been a rotation from corporate to sovereign bond funds, as well as from growth to value equity funds. After the start of the war, there had been renewed interest in inflation-protected bond funds in anticipation of higher inflation, and in commodity-related equity funds in the light of the surge in energy prices. Higher interest rates may translate into higher refinancing needs. This could put sovereign debt dynamics on an unfavorable trajectory, especially in higher debt countries. Countries with higher sovereign risk have taken advantage of low rates to prolong their debt maturity profile, which reduces their vulnerability to abrupt changes in market sentiment. Along with Thursday's rate hike, the European Central Bank is also set to signal a string of subsequent increases. It already flagged a 50 basis point hike for September, and that is likely to remain on the cards. It is also expected to pledge further moves, though less likely to make from commitments. Banking group BNP Paribas said in a note, "Our central case is for a 50 basis point hike in September, but we think the governing council will leave the door open for a larger move." Markets now see around 92 basis points worth of hikes by September, and a combined 170 basis points of moves by the end of the year. Don't forget to leave a like and subscribe for more. World of Finance TV has videos every Monday and Friday.